Good morning. I thought I went live, didn't go live. Now I'm live. We'll give folks an opportunity to join here real quick. Last day of the month, quarter, first half of the year. We kind of ease into this data cycle with jolts at 10 o'clock. It was glitchy for a second. I don't know why we were glitchy. The internet, it's fallible. Yeah, a lot of data, a lot. A reasonable amount of data overnight. Haven't been really talking about global data the last week or so, mostly because really there wasn't a heck of a lot to talk about. We did get inflation in 3 or 4 regions and pretty much across the board, and maybe arguably most notably Italy. And pretty much across the board, the inflation numbers were bond friendly, generally speaking. So, one wonders if that's going to be a precursor to our data cycle. I'll talk a little bit about those numbers here. First, let's just say stocks generally better overnight. We're indicating mixed here onshore. VIX down about a point. Bitcoin 58 and change. Dollar stronger versus most currency. And oil prices above the 60 handle. Crude back up to 71. Brent approaching 75. And really for the better part of the last week, we were talking about crude being firmly in a 60 handle and Brent fast approaching. Pretty much commodities up across the board. Might be a little bit of profit taking on some shorts. Sometimes you can't really read into quarter end and quarter beginning positioning. I mean, there is a squaring up. Some of these funds kind of have rules to follow. They can't be too much into that and not enough into this and so on. And, you square up and that all kind of plays into the mysticism of the markets. And, you've heard me say this, and I'm not going to pretend to have coined this phrase, but the trend is the trend until it's not, or the range is the range until it's not. And if we know that there is support or resistance somewhere, you're not the only one. And so it becomes a self-fulfilling prophecy. I mean, think about it like, and I've never used this analogy before, but it's a pretty good analogy now that I'm kind of thinking about it, right? It's like bedtime. If you go to bed every night at whatever time, doesn't matter, pick a time, 10 o'clock, it's not so surprising that you go to bed at 10 o'clock tonight because you went to bed at 10 o'clock last night and the night before, right? And that's basically the market, support or resistance. We know that the last 2 times that a stock or a bond has gotten to this level, we've bought or sold as a market, right? And then every once in a while, you make different plans, or you can't fall asleep, or you fall asleep early. And that's sort of breaking the range. And so, I think that when you look at sort of month end or quarter end contemplations, if you've already made all your money and you need to kind of hit certain thresholds, the market can become fairly predictable. In a quarter where maybe bonds did poorly, they tend to rally at the end of the month, and stocks did well, they tend to sell off at the end of the quarter, or vice versa. No onshore 8:30 data. So we've got the headline for today is jolts at 10 o'clock. But when we look at some of the data that was somewhat bond friendly overnight, where was my CPI stuff? PPI in Hungary missed 0.3, came in at negative 0.7. That's a pretty bond-friendly number. Producer prices in Italy printed at 7.3, which was hot, but the monthly came in, and this is something else we've talked about looking for here onshore. So we expected 6.8. It came in at 7.3 on the annual, but they expected monthly at 0.3, came in at negative 0.2. Now that's deflation, and we've talked more about looking for disinflation. But if we have any precipitous drops in oil prices, and why I would look at a number, from an offshore region is, to whatever extent, well, first of all, the economy has become more globalized. But secondly, to whatever extent the price of oil and gas is driving this, which is sort of what the Fed and bond hopefuls have been hitching their wagon to, well, that stands to reason anywhere. If there have been pricing pressures in Italy over oil, and all of a sudden we have a surprise monthly print in the negative because the price of oil dropped, then one could anticipate, extrapolate, or just plain out, straight out hope that the same happens here. Normalized CPI came in, CPI came in flat, down from 0.4, and normalized came in at 0.1, expected 0.3. So really, really, really good numbers out of Italy from an inflation standpoint. And one would hope that they would happen here too. I'm going to assume DE is Denmark, wherever it is. And again, this is not anything that you're going to bet the farm on. It's just indicative. If it's not sort of Eurozone, Japan, I say China. China matters big time, but I don't know that everybody always trusts their data. And maybe GB, and then Italy, Germany to lesser extents. But here we expected negative 0.2, printed negative 0.3 on CPI. So those are sort of good signs coming into our data cycle. What will it mean for us? Who knows? What I know here is that we have a bunch of housing data at 9. By the way, for April, so a little behind there. Chicago PMI for June, getting that super early, considering last I checked the calendar, today's June 30th. And JOLTS, that's the big one for today. We are getting May. Why are we getting May? Are we still behind? Anyway, we're getting quits and openings, and we're getting some consumer confidence and all the stuff that goes along with JOLTS and some of this secondary data that we're going to get. And then tomorrow morning, 8:15, we'll get on at 8:13, is ADP. So how do we handle the next less than 24 hours? Because it's 8:34. Well, if we look at Ginny 4.5s on a 5-day, we're at, call it 96.11. We're about a quarter point, maybe even 30 basis points off the best levels we've seen. Still in some pretty good territory around the best levels for the month, and really around 3-month resistance, to be quite frank. So, that's why we've been on a lock bias there. 5 coupon, a bit more 6-month middle, mid-board. I'm going to say a bit closer to 3-month mid-board. But if I show you that, right, to whatever extent you could see it, we are clearly at resistance here. And so, before I go there, let's just look 5.5s, a little bit beyond mid-board. I'd say about 80% to 3-month highs around some resistance. And like that's your 6 coupon chart to whatever you can, see that. Again, no reason not to lock sixes and 6.5s. So the $1 million question is, how much risk do you want to take going into tomorrow and Thursday? How much risk do you want to take going into, what may be the two most important data points that we're going to get, not in reality, but in terms of perception, is ADP at 815, which theoretically is going to be a very short-lived number because right behind it is going to be Jobs Thursday, right? Why do I think that these numbers are potentially important? Well, because I feel strongly, and I've been talking down this month's inflation data, and this early data is supportive of that, is I think that it's hard for me to envision a scenario whereby this pass at inflation isn't going to be somewhat bond friendly. Now, to whatever extent we've ratcheted down expectations, that's a horse of a different color. But to me, and I'm not certain what day we're getting CPI, it's usually around the 12th. If I had to take an absolute guess, looking at the calendar, 14th, CPI 14th, PPI, let's see, June CPI report, Tuesday, July 14th. Yeah. So, you've got 12, 13 calendar days in between Wednesday, Thursday jobs reports and that CPI data. And there's a lot of lock float considerations that are going to be made in that period of time. And I think if we do end up getting some friendly inflation reports, which I'm going to tell you, I think is like 85% likely, right? Then we don't want to necessarily be cranky for a week and a half, 2 weeks going into it. So I think that it's really important for the month of July, not the enormity of the mortgage business, but the month of July, for these two data points in the next 48 hours to go our way. Because what I think it'll do is it'll reduce some tension. Hopefully we finalize some sort of deal out of Iran, and our inflation data continues in the direction we set this month, continues in the direction of this early offshore inflation data, and kind of comes in where we expected. Let's see, June CPI report expectations. Let's see if we can get a sense of core is expected to hold at 2829. Headline is expected at 4. Where are we expecting monthly core? 0.3. So that's not a number that necessarily sets us up for failure. I don't know if we land there. By the time we get there, these expectations might change over time. But we're not expecting flat, okay? So, and I feel like 0.3 would be, the market would almost interpret that as a beat, almost a sigh of relief. So I feel really, really good going into these inflation numbers. Don't feel as good going into these jobs numbers because they're just so darn unpredictable and volatile. But, long story short is the question is, how much risk do you really want to take on? I'm going to say if you got a loan closing in the first 2 weeks of the month, I don't know why you wouldn't be fully locked here. I think that if you're closing last 2 weeks of July, I'm 70% lock. just because, again, you don't have the time you need to react, but you do have some time. If I'm going out beyond that, I feel like we're headed in the right direction. I am cautiously optimistic, and I would play those floaters on a day-by-day basis. So there you have it. If you have any questions, drop them in real quick. Otherwise, 8:30 tomorrow morning, and we'll see what this ADP number looks like. Remember, bulls and bears make money, pigs get slaughtered. Thanks for joining live, and thanks for everybody that watches on replay. See you guys. Finish the month and the quarter strong.